Morning. Top Gun here, a little before 4 a.m. on Wednesday, April 21st. This is the YouTube pre-market commentary. All right, section 1, QQQ, failed breakout watch. All right, very important. Take a look at these, the charts of these tweets from Alfonso de Pablos, JC Pare, and Yuri Matzo, where you see the NASDAQ 100 as represented by the QQQ ETF, or Yuri uses the NASDAQ 100 futures, but both broke out from their February 12th highs. The closing high on February 12th was 336.45, so they broke out on Friday, April 9th. But now we're trading back down. Yesterday we closed at 336.41, so right at that level. So we're looking at a potential failed breakout. And what that means is there just isn't, demand doesn't exceed supply. The supply-demand dynamics are not strong enough to sustain prices above that breakout level, and so the security or the stock is simply not ready for those levels. And so, being that the QQQ is the most important ETF in the market, this bears some close watching because the failure there, and especially with everything else mostly rolling over, and the mega caps leading, this leaves the market kind of without leadership. So it's quite significant. Okay. Number 2, PG, Procter & Gamble, and Netflix earnings, a tale of two kinds of stocks. All right, so yesterday I was talking about the breakout in defensive stocks, and yesterday provided a nice illustration of two kinds of stocks. Procter & Gamble being quality and defense, and Netflix representing momentum and glamour. And of course, momentum and glamour have led us since the March 2020 lows, but it looks to me like that might be petering out, and the XLP defensive stocks, consumer staples, have been breaking out. That's how I'm positioned, and I think that's the place to be right now in the market. And yesterday's 2 reports confirmed that for me. So Procter & Gamble reported a solid quarter with organic revenue up 4%. And core EPS up 8%. They also stuck to their fiscal year core EPS guidance of plus 8 to 10% from the 512 they earned in fiscal year 2020. So the stock is not cheap at 25 times current year earnings, but it's working, and it's quality, and it's defense, and it was up 0.83% yesterday, while the S&P was down 0.68%. So I like it. Netflix, on the other hand, reported after the close, and for Netflix, the key metric has always been subscriber growth. Investors in these types of stocks are not really worried about going too deep into the fundamentals because they figure as long as there's growth, they'll figure out a way to make money in the future. Now the problem is that when that growth starts to flag, as it did for Netflix when it guided yesterday, second quarter subscriber additions to only 1 million, that can lead to a real collapse really in these types of stocks, which are very, very highly valued and flying high and riding high, as Netflix is. And it's down, last time I checked, about 8% in the pre-market, and looks to be to test its 200-day moving average today. So interesting little dynamic right there. I will see you guys. I'll see you guys tomorrow.